Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
Volatility comes with the territory when owning risky assets, yet investors seek ways to hedge against it or even profit from it. So how can you capitalise on market turbulence, and is it worth the effort?
I want to explore when these strategies are most effective and the risks they carry. And in today's dumb question of the week, what is the MOVE index? All right, let's get into it. It almost goes without saying that if you want a high return from an investment, it's going to come with higher risk. It's basically a truism of markets. But that volatility doesn't have to be an enemy. Sometimes you could treat it as a friend and actually generate a return from the volatility itself. Now, I don't know a huge amount about this, but I know someone that does. Someone actually wrote the book on volatility, didn't they, Robin?
Yeah, another train-written book. And it is interesting that you can take something which is supposedly just a statistical measure that you probably remember from your GCSE mathematics days, which is volatility. It's actually called standard deviation if you were doing it in maths, but you can actually make money from it, which seems very odd. You can turn this volatility into cash.
So maybe before we get into all the details, we should just be absolutely clear. You've mentioned volatility and standard deviation. What do we actually mean by volatility?
Well, there are various ways of measuring it. The standard way, if you're just looking at realized volatility, as they call it, is to take the typical annual percentage price move of an asset, and it's expressed in an annualized form, so it's a percentage move per year. And if it's very risky, like cryptocurrency, then it's 80% or higher per year. If it's very safe, then it'll be something like a money market fund where it can be less than 1% per year. So that's the kind of spectrum of risk. And the thing is, things which have high volatility tend to crash more as well. So stocks, very crashy, particularly EM stocks, single stocks. And then as you reduce the volatility, you diversify your portfolio, you get a better risk-adjusted return, the return divided by the risk.
So what would be a typical volatility for an equity market index like the S&P 500 or the FTSE 100?
So there you'd be looking at something like 16, 15, 16%, something like that. And then for single stocks, much higher, because there you're just taking the risk of a single company.
And so for something like the S&P 500, that volatility of, let's say, 15% basically means you shouldn't be surprised if it's up 15% in the year or down 15% in the year. That would be normal. Maybe you should be a little bit surprised if it's up 30%. Is that the kind of ballpark we're talking about?
Yeah, that's spot on. And volatility traders have a rule of thumb called the rule of 16, where you divide by the square root of 252, because that's the number of trading days in a year. And that'll give you the daily volatility, which is handy because we tend to look at things on a daily basis. So if we take that 16%, divide by 16, that tells you that the typical daily price move is going to be about 1% for a global large stock index. And if it's more than that, then that would be a bit surprising. 2% would be a bit surprising. 3% would be shocking. 4% would be flabbergasting, perhaps.
And can you translate these numbers into like how often they would happen? Like how often would you get a 10% daily fall?
You can, but then you have to make assumptions about the distribution of returns, or you could do it empirically. And, this is how I came up with the 2-6-16 rule, which is to do it empirically. Look at the size of the crash, look at the period of time, and then count how many times that happened historically. So really big moves, 30% or more, over a 1-year period, you have to specify the period, happen with a probability of about 2%.
That's the probability that the index will be more than 30% down in a year's time. It might do more than that in the meantime.
That's right. And that's why you have to specify the period. Now, that's all realized volatility. Okay, that's the stuff you can't trade. You can't trade realized volatility.
Because it's already happened.
Yeah, and it's just a statistical measure of price movements. What you actually trade is something called implied volatility, and that's where you make your money.
Okay, so what that sounds like is what the market is expecting volatility to be in the future, presumably over some period of time. Is that just a guess? How has it worked out?
No, it's not a guess. It's actually a traded thing. So it's the traded volatility that is the actual price. And markets discover what the true implied volatility is for anything.
Is it not just an aggregate of guesses then?
It can be, and we'll talk about these indices later, but for a single stock, it's the amount of money people are willing to pay for a particular option on that company. So if you speak to a derivatives trader, they won't say I trade derivatives, they say I trade volatility. They think of it as a real thing, and for them it is. But it's a little bit like bond yield and bond price. People get confused about that. But in fact, that's just two ways of quoting exactly the same thing. And if you look at the price of an option and the volatility, the implied volatility of the option, again, it's just two ways of quoting exactly the same thing.
And am I right in saying that a higher implied volatility would mean a higher price for the option? Because a greater volatility means there's more chance it'll end up in the money and paying out.
Yeah, that's right. Higher implied volatility means a higher price for the option. Now, for a very long period of time, the stock market was very simple. If you buy something and it goes up in price, you make the same percentage return as the price has gone up, net of fees. If the price goes down, you lose money 1 for 1. However, when options came along, which was a very long time ago, it's over a century, I'll use Ford stock as an example because that was around when options started. But the idea is you've got the option, but not the obligation to buy Ford stock at a fixed price at a fixed point in time. If Ford isn't above that price at that time, then the option will expire worthless. So you've got a very high chance of losing 100% on an option. But the beauty of an option is that you only pay a tiny fraction of the price of the individual stock. So you're making a small bet with huge upside. If you buy a call option, for example, that's the option to buy. You also have an option to sell, in which case you've gone short the stock. So instead of having to buy all of the risk, the upside and the downside, you can trade the two separately. And you can go long, you can go short. So you can carve up the risk profile of any investment using these options. So it's so beautiful. The maths is just gorgeous. And, this is a quant's wet dream because it's just so beautiful. I just can't describe it without getting goosebumps.
I never want to see inside a quant's wet dream. But I do like the idea of separating out the upside and the downside. Because like you say, we always think of it as stocks go up, I make money, stocks go down, I lose money. But when it comes to volatility, does that price direction matter? Volatility is kind of neutral, right, to whether it's going up or down. It's with the options that you can separate those things.
Yeah, that's true to a certain extent. When you buy an option, you're long volatility. Whether it's a put option, which is when you make money when the price falls, or a call option, which is when you make money when the price rises, both of those positions are long volatility. Volatility goes up, there's a bigger chance they pay out. And you don't have to wait till expiry of the option to sell it. You can sell them before they expire. So if you're a professional investor, a professional derivatives investor, then yeah, this is how you're going to make your money. However, for most of us, we can't trade single options. Even though in the US you've got Robinhood, which made it very easy to do so. Lots of people made millions on Tesla, for example, call options on Tesla. The vast majority of people, I think, really aren't geared up for thinking in this completely different way. They haven't got the right mindset in order to trade options, which is you make a small bet, you've got a very high probability of losing everything on that single trade, and also a reasonable probability of making a high payoff, which is in fact leveraged, because you just put down a fraction of the value of the end payment.
And presumably the characteristics of that bet, like how likely are you to lose versus how likely are you to win, depends on the specifics of the option, like where's the strike price, what's the period of time, what's the underlying asset, all of that stuff.
Yeah, that's all stuff you have to gauge, and also look at the implied volatility, because what the options pricing formulae, like Black-Scholes, allow you to do is to take the price you paid for the option in pounds and pence or dollars and cents and convert that into an implied volatility. And that's what everybody trades, the implied volatility. So usually what you'll do is you'll compare that implied volatility with realized, that's backward looking, and say, look, do I think the volatility of this thing's going to go up? In which case, yeah, I'll buy the option. So some people buy it just to go long or short volatility. Some people do it in order to hedge their risk. If you buy a put option on the thing you've already got.
That's called a protective put, right? You might own the Tesla stock, but also buy a Tesla put with a strike price below where it is today to cap your loss at 10%.
Yeah, and people often do that when they get nervous. So if you're a professional investor, it's very often the case that they'll say, look, we've had a good run on this stock. Instead of selling it, I'll just buy a put 10% below where the price is today.
It's kind of like a limit sale, right, in a way.
It is, except it's nice because you can craft the size of the trade, you can craft the expiry of the trade. All of these things are very flexible. And you don't actually have to sell the thing in order to hedge it. Because one of the problems with stop loss is often markets move so quickly that you don't end up getting the protection. There's no guarantee it'll be sold in time if there's a huge downward move, whereas the put option will always pay out.
I mean, you might notice that we've done this episode during a period where volatility has gone up, right? We always like to focus on what's in the news, and I think it has been forefront of investors' minds. And one thing I was wondering is, does a higher volatility always mean that the stock market is going to have a fall, a negative performance? Do they go hand in hand?
That's really interesting because what often happens is during periods of very high volatility, you get very large negative returns, but also very high positive returns. So if you think about black swans, what goes hand in hand with black swans are golden swans. Presumably they wouldn't be very good at swimming, but the beauty is that you have these very large positive returns. And if you sell when you get the big negative return, then you'll suffer from the black swan, but you won't benefit from the golden swan as markets bounce back. So I think that's what people don't realize, is that volatility goes through these periods of quiescence when nothing happens. And then you get periods of really high volatility because it's called autocorrelated. When you look at volatility day to day and you go through these high vol periods and low vol periods. And currently, as you say, high vol period.
And the way most people, I think, determine whether it's a high vol period or a low vol period, certainly the media, is by looking at what's called the VIX, don't they?
Yeah, that's the standard index of volatility. So how do you work it out? It's based on a huge portfolio of out-of-the-money options on single stocks in the S&P 500. The idea here is that you can combine those in a beautiful mathematical way. I won't talk about it, but it is so cool. And what it gives you a read on is what people are willing to pay for a big move in the S&P 500 over the next 30 days, over the next 1 month. So if VIX goes up, you can tell that people are paying more for options, out of the money options, either for the upside or the downside of stocks in the S&P 500. So really it tells you about expectations of market moves rather than where the market's going to be. And it isn't directional. It could be for up or down moves.
So this is the granddaddy of implied volatility. Market-wide implied volatility.
Yep, and there are lots of funds which actually track the VIX, which is kind of weird. Yeah, the reason why I wrote the book about volatility was because I heard that grannies were trading VIX funds, and I don't think they understood it. So that's why I thought I'd write a book explaining how it works.
I remember when I first got into investing, quite a long time ago now, I read some advice somewhere on the internet, which I still remember from some successful trader. And he said, I have 2 rules. Don't fight the Fed and don't short the VIX. I don't know why, but I just remember that.
You can short the VIX pretty easily. You can buy short volatility ETFs, which essentially make money from selling options. Now, this is fine until you get steamrollered. And some people describe this like picking up coins on a train track, which is fine until the train comes along, because you can make money by selling the options, but then you get wiped out if the market moves against you.
I guess that's why he said, don't short the VIX.
That's exactly why. Yeah.
And I never have. Never gone long the VIX either, to be fair. But there seems to be quite a division here between when we're talking about retail investors like us and what professional investors, derivatives traders might do. And from what you're saying, it sounds like they're more into what might be called non-directional investing.
Yeah, for them, it's all like chicken. Upside, downside, they can craft the payoff any way they like. And this is in fixed income, currencies, and stocks. You can have options on all of those asset classes, or any asset class, in fact. And what gets really interesting is when you combine these different option strategies and you come up with some crazy names. And I laughed last night because you looked at some of the strategies and you said you liked them straight away.
Yeah, I came across something called a reverse iron condor, and I thought, I'm buying it. I don't care what it is. That's what I'm implementing.
But when I used to teach people about options, when they were kind of sleepy after lunch, we used to stand up and I'd make them make all the shapes of the different payoffs. So you could do long call, short put.
Make it with their body, I should say, because you're doing like some crazy arm movements here, like you're in rhythmic gymnastics.
That's right. Long call, short put. That's a synthetic forward. So you can do all sorts of payoffs with these things. You can craft the payoff any way you like. You can make money if something stays within a range or goes beyond that range, or you could sell the upside and buy the downside in order to make the strategy cheaper. There are so many things you can do. And structured products are a way of essentially crafting the payoff so that you can market products to rich people, which is another episode that we've done, and which I think also shows you the dangers of options, which is that they seem too good to be true.
Because everyone would like to have the return of stocks with none of the risk, but that's impossible.
Yeah, the salespeople love them, absolutely love them, because, they can go to any client, and if it's a scared client, they'll be looking at protective strategies. If it's a greedy client, then they can amplify the upside, buy 2 call options, 3 call options with something called a speeder. So, you can craft it any way people like. If they like income, yep, you can have that.
But as I understand it, it's not just structured products and professionals. When you look at fund flows, a lot of money from retail investors has gone into products that are either hedging or benefiting from volatility. Things like covered call ETFs have become very popular in America and now a little bit in Britain as well.
Yeah, because you look at an index like the S&P 500 and it pays a tiny dividend, usually less than 2%. And you think that's not very generous. So how about having the S&P 500 with a dividend of 8%? That sounds great. It's easy to market, right?
Yeah, but none of the companies in the S&P 500 pay 8% dividends. Or maybe a couple do, I don't know. But not very many.
And that's why if you have these things, these strategies where you overlay a short option position, you can actually craft a fairly high dividend for something like the S&P 500.
All right, talk us through the mechanics of how that works, because people might not understand this. Let's take the NASDAQ index, right? Because that's a very popular one because it's highly volatile. In theory, if you just buy the NASDAQ directly and own the index, you've got a maximum downside risk of 100%, right? The NASDAQ in theory could go to 0.
Yeah.
You've got an uncapped upside. It could go to infinity, I guess, in theory. And you get a dividend for holding it, a very small one. I'm not sure what it is right now, let's say 1%. But these covered call funds upend all of that while still kind of owning the NASDAQ.
So let's take one fund as an example. This is the one from Global X, but many of them are quite similar to this one. What it does is every month it sells an at-the-money NASDAQ call option, which means that if the NASDAQ rises above the price on the day the option sold, then you don't get any of the upside because you own the NASDAQ as well. So you've capped your upside from where the NASDAQ is today. You don't participate in that at all.
But why would I want to do that, right? I've given away all the upside. The whole point of the NASDAQ is it goes up a lot of the time.
Not only that, Michael, not only that, you've also kept all of the downside. Now that sounds bonkers. But the point is that by selling the option, the very expensive option, you pocket a fair old amount of money and you can pay that to your investors. So every month that option expires and the fund manager sells another option on the NASDAQ. Now you're probably wondering, this sounds really toxic. I've kept all the downside. I've lost all the upside. What kind of income do I get? Well, it's 12% typically for that ETF. So that's why people get attracted to it. And I've been experimenting with it too. So I've bought it in one of my ISAs just to see what happens. Laura's got some too, in fact.
And the fund actually pays out that 12% as a dividend, right?
Yeah, so if you invest £100, you get £1 every month. £12 every year, roughly. It does vary because the volatility of the Nasdaq varies.
Is that what drives the yield, the volatility? High volatility, like we said earlier, means options are more expensive. And if you're selling the option, there's more money in your pocket.
That's right. Crashy periods. So recently we've had a bit of a sell-off as we make this podcast. That makes the volatility go up, and that means that you get a bigger income.
But the index has been falling, right? So that income is just offsetting the fall a little bit. What you really want, I guess, is volatility where it's not going down, down, down. It's going down, then up, then down, then up. Volatile, but without a crash.
That's right, which isn't far from what we've had. We haven't had a big fall. All we've had is a little bit of a shock, which has rattled markets. It didn't go down much. It's probably going to trade sideways for a while because people are now scared. But it did bounce back quite a lot. And again, that just feeds into the volatility engine. And what I've done is to automatically reinvest the dividends back into the fund. So when it falls, volatility goes up and you buy more. So you buy it at a cheaper price. So I like that construction because I'm not living off the income. I'm just monetizing the volatility to buy the Nasdaq.
Yeah, you're just compounding that fund beautifully until we get the massive crash.
That's right. And that's when I'll be really upset. Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 stocks and shares ISA is the cheapest way to invest, with zero commission and the lowest FX fees I could find on the market. Looking to keep things simple, you can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. If you trade US stocks, then 24/5 trading gives you non-stop market access from Monday until Friday via more trading sessions, while still using Trading 212's fractional shares and zero commission trading. You can also switch between 24/5 and regular hours orders at any time. Customers can also benefit from the Trading 212 card, which offers 1.5% cash back on all transactions until October the 1st, 2024. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 Invest or Stocks ISA account, make a minimum deposit of £1 and use the promo code RAMIN, RAMIN, within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk and you may get back less than you invested. Past performance doesn't guarantee future results. Pies and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You're responsible for all investment and rebalancing decisions. Free shares can be fractional. Terms and fees apply.
But I did see an article in the FT last week, and the headline was, "Funds offering protection from volatility fail to deliver in sell-off." And this was about covered call ETFs like this one, and how they've lost almost as much as the underlying index. And investors are a bit like, what's the point of this?
Now, strictly speaking, I don't think these should be marketed as a volatility-reducing investment, although technically they must reduce volatility, because if you've taken away some of the upside, then half the volatility is gone. Unfortunately, it's the positive volatility which you lose some of. But that's, I think, misleading. I think the way they should be marketed as you can own the Nasdaq, but with a high income.
Nah, but do you own the Nasdaq? Like, you do technically own the Nasdaq, but you've given away all the upside, which is the characteristic of the Nasdaq that people like.
Well, you kind of own the volatility of the Nasdaq. So it is part of the Nasdaq, I think.
Yeah, but it doesn't have to be the Nasdaq, right? There's loads of volatile indexes, whether it's tech stocks in China or whatever. It's not the Nasdaq here that's special. It's the risk of a crash being traded off against monetizing the volatility of the index.
Yeah, if we imagine the perfect world for covered call funds, it would be one in which markets don't go up, they just trade sideways with huge volatility, which does sometimes happen. If you look at the history of the Nasdaq, the S&P 500, what you tend to see is periods of not much growth, maybe lackluster growth, and then periods of massive growth. So it's not a steady upward trend. It's more of a kind of staircase. Unfortunately, we can't predict when the staircase is going to happen. Maybe you could say when you've got very high valuations, as you do now, that would be a period of weaker growth. So something like a covered call fund would make sense. And certainly that's part of the reason why I bought this covered call ETF. And I should stress that it's part of my fund portfolio. I've only got a tiny bit of it.
And it's not just you that have bought them. As I said, they've become increasingly popular. So I know that in the US, assets under management for these covered call ETFs grew from around $18 billion at the start of 2022 to around $80 billion as of now. That's according to Morningstar. So we've got, more than a quadrupling of assets under management for these kind of funds.
Yeah, a popular one in the US was JEPI. And the idea with JEPI is that it's actively managed, and it's managed by JP Morgan. But what they do is they buy US large cap stocks, but overlaid on that, they sell some upside for some of the stocks. Now, presumably, because this is actively managed, the ones you sell the upside on are the ones where you don't expect huge growth. So the lousy stocks, maybe the volatile stocks, and that option overlay essentially just boosts the return on the S&P 500 or something close to the S&P 500. So in theory, that way you get to keep the upside with the additional income. In practice, recently, it hasn't done amazingly well during this sell-off. So really it depends on which stocks you choose to sell the upside on and which ones you go long. But I think that's another interesting twist on this covered call strategy, being selective and actively managing the option overlay and the stocks.
Yeah, it's interesting you say that, because this morning, as I was pushing my daughter up to nursery, I was putting myself in a kind of hedge fund mode. I was thinking, what would I do? What strategy would I do here if I wanted to, try and make money and actually lose a load of money?
What you actually mean is lose someone else's money, Michael. Very important distinction there.
Oh yeah, the dream, the hedge fund dream. And what I was thinking is volatility mean reverting? Probably, right?
Oh, yeah.
And so what that would mean is if we're saying that you benefit more by selling options when volatility is high, so these covered call strategies work well when there's high volatility, shouldn't you have a selective approach where you only write the call option when volatility is high, and when it's low, you don't, or at least you write less of it, and you have an actively managed covered call fund where its income is going to vary, sure, but presumably, if volatility is mean reverting, that should work out.
Yeah, and there are funds which do that, which try to time volatility. Obviously, you want to sell the options when they're expensive and buy them when they're cheap. But unfortunately, you can't time these things very well. And I think for some of the larger ones which try to adopt that strategy, they haven't done very well.
Yeah, but I would time it better than they did, Roman, if I set up a fund, surely.
At least that's what you'll tell your investors.
Is volatility as hard and basically impossible to predict as market returns? Like we always say, market timing is impossible. Is it as impossible for volatility?
For big moves, I think it is, simply because it's unexpected shocks which generate volatility. Another way of interpreting volatility is information flow. When new information hits markets, there's been some fraud at a big company and it's going to go bankrupt, or something like Lehman Brothers. That's information, and the market has to reprice risk when it happens.
Could you not say that there are known events which are going to cause volatility, though? An election, some earnings report, whatever it might be? Or is the whole market aware of that and therefore it's already expected to be high volatility anyway?
You bet. And that's what you see. If you look at the options curve, it's kind of interesting. On Bloomberg, if you have a Bloomberg terminal, which sadly I don't, you could draw these beautiful volatility surfaces. So imagine that you've got one dimension, which is time into the future. You've got another dimension, which is the strike of the option. And you could see these bumps in the volatility surface. And then you could write about it, because often they were timed with these events, because people were buying options based on that event. And you don't have to have a directional view. You can just say, look, I'm going to go long vol on that day. You buy the call option, you buy the put option, and you've got a straddle. If you want to make it a bit cheaper, you have something called a strangle. I'm actually drawing these out with my hands. We should do some kind of...
Yeah, people always say you should do a video podcast. And this is the one time I thought they're right. Because Robin's been doing like sign language interpretation throughout this whole thing, drawing graphs with his hands and his arms.
But coming back to your point, the serious point, yes, markets price in higher volatility. The options get more expensive before these events occur. So it's already kind of priced in. And you probably guessed I was going to say that.
There is something called the VVIX. So we've talked about VIX, but there's VVIX, which is the implied volatility of volatility, which is a little bit like chasing your own tail. I don't know.
Yeah, whenever I talk to strategists, they get very excited about VVIX. But I always think that, if you get these second order derivatives, most human minds just aren't geared to understand that. Will volatility increase in the future or will it go down? And that's what you're betting on in this case.
But you're not most minds, Roman. You understand this. Talk us through it. You can't trade it really, can you?
It's difficult to trade. I mean, if you're a professional investor, you probably could, but not as a retail investor, which is probably just as well.
But if VVIX is going up, it's not saying volatility itself is going to be higher in the near future. It's saying that
there'll be a change in volatility.
The rate of change of volatility is going to be high.
That's right, either up or down.
Yeah, I am most minds, and I will never trade that.
But I always think if it's something so complex that you can't explain it to a kind of normal friend, a normie, then you probably don't want to trade it.
But that applies to pretty much everything we've said today. All these option strategies are very hard to explain, at least without seeing your waving arms.
Oh, yes, the arms really clinch it, I think, in terms of understanding.
But I think it is a key point with this stuff. Don't buy things you don't understand. It's like rule number 1 of investing. And not just things you understand in normal times. You need to know how it works when everything goes wrong.
Yeah, and what to buy if you think things are going to go wrong. So some people buy strategies which essentially craft a payoff so that you can erase your worst fears. Unfortunately, many of those fears don't materialize and the option expires worthless. But it's like insurance if it's a protective put. It's like saying, oh, I didn't have to make use of my fire insurance because my house didn't burn down. I feel really disappointed about that. You're not going to say that.
And the point with insurance like this is you're paying for it and it will lower your long-term returns. There's a cost. You don't get free insurance. And I think the more sobering point is that if you've got so many fears that you're hedging loads of different risks and you hedge out all the different risks, all you're left with, by definition, I think, is the risk-free rate. And you're paying loads of fees on it, so you'll get less than the risk-free rate. If you don't take risk, you don't get excess return.
And that's a beautiful summary of it, which I think is really critical, which is that if you don't have risk, you don't get return. And if you hedge everything, you don't get anything.
There's no free lunch. We say it again and again.
Well, the risk-free rate is the risk-free lunch. So that's what you'll earn. But for most people, that's not enough.
And if you just want the risk-free rate, buy a treasury. Don't just hedge out all the risks on some bizarre options equity strategy. But I guess the point for us as long-term investors, week after week, we talk about a buy and hold strategy effectively. Whatever it is you're holding, you want to be able to hold it for the long term and weather volatility. You're buying something in the belief that over the long term it will rise, there'll be short-term dips. But if you're not looking to sell it in the next 20 years, you can look through that.
And this is another key point, which is volatility is to do with time. And what's odd with equity is that the volatility matters less the longer your holding period, because the drift upwards tends to dominate the volatility. So if you are a day trader, all you see is volatility, and it's like betting on the flip of a coin. If you're a long-term investor, what you see is the upward drift of stocks. So you can ignore volatility. That's a superpower. And speaking to young people, I always love it because for them, volatility is their friend. If there's a crash, they can buy cheaply. Whereas someone who's post-retirement, volatility is their enemy because if there is a huge fall and you haven't positioned for it, then you could suffer a fairly large loss. And then you have to crystallize it because you have to sell stuff if you haven't got safe stuff. And that's going to affect the longevity of your pot.
Your holding period is everything, really, when it comes to investing. I love your point that day trading is a coin flip, basically. I saw a comparable stat around Roger Federer, obviously the successful tennis player. He played over 1,500 singles matches in his career and won around 80% of them. Wow, you might say. He must have been really good at tennis. And he was. However, if you look at the individual points he won, 54%. Doesn't that mirror the market, though? On an individual point basis, it's a coin flip. But the very slight move in his favour means that over the long term, he's a big winner.
Yeah. I remember when I first plotted the distribution of returns for an index, I think it was the S&P, I thought I'd got it wrong because it just looked like it was centred at zero, as many positive as negative returns. But in fact, there's just a very slight shift to the upside if you look at daily volatility. And that's enough to generate these huge long-term returns. But it's almost invisible if you plot the histogram of returns. So like you say, that can really skew things in your favour. And often people say that if you're a trader and you manage a 54% success rate or even a 52% success rate, then that puts you above the huge majority of investors.
As long as you're consistent with it and can avoid a huge drawdown at some point.
Yeah, which clearly many of them don't do.
I think the thing with all these volatility strategies is that they're kind of by their very nature relying on market timing and are short-term plays, right? If you look at the documentation for most of the funds we've mentioned, it usually says stuff like these are not suitable for long-term holding explicitly in there. I'm sure people do hold them for the long term, but the fund manager at least has to advise that this is not a suitable product for that.
And if you plot the return of things like covered call funds long term, they underperform the underlying index because you've given up the upside. And if you buy a protective put strategy where you buy the index and cap the downside, again, it underperforms because you're having to pay out this option premium all the time, and that is a huge drag on your return. So these overlays, like you say, work in certain environments, sideways markets for a covered call, downward markets for a protective put, but not over the long term.
And just to wrap up, there's a kind of provocative question, which probably underpins a lot of this discussion, which we've not really touched on. Is volatility synonymous with risk?
I don't think it is. And it's very clear that if you're an investor, what really matters is not achieving your goals. That's the real risk. And that's nothing to do with volatility. Plus, there are certain investments, things like credit, corporate bonds, where the volatility is very low. But that doesn't mean it's low risk. It just means there's not much trading, the prices don't move much. But when they do, when they move against you, it can be a very sharp and sudden sell-off. So this is why credit investors are usually the most miserable people on earth. They're always looking at that downside. Whereas equity investors always think it's a happy, shiny day because they live off upside.
Volatility can disguise a lot of risk, can't it? Like you say with credit, where there's always the risk of a default and a sudden sharp drop, which is not captured in daily volatility. And private equity, goes out of its way to disguise its volatility. That's the whole point of it, right? They don't mark to market as much as they perhaps should.
Volatility laundering, that's what they call it. We won't tell you how much the price has changed, therefore the volatility's not there. House prices, very similar. You don't know really what the price of your house is until you try to sell it. And then there's sometimes a nasty shock, sometimes a nice surprise.
For me, as a long-term equity investor, the better way than trying to hedge out the risk of volatility and drawdown is to psychologically get comfortable with the ups and downs of markets and steel yourself to weather the storm. For most people, I think that's going to be a better way forward for most of their investing career than messing around with all these options.
Yeah, perhaps meditation is the best strategy here. Just learn to accept it and let the volatility just roll past you. Volatility is an inevitable consequence of being invested in stocks. So don't be scared. Join a community where we approach investing in the correct way, which is not to fear volatility, but to use it to invest better. If you want to learn more, just go to our website, PensionCraft.com/membership. Okay,
today's dumb question of the week is, what is the MOVE Index? MOVE.
Now, everybody talks about volatility for stocks, but how about bonds? I love bonds and I love volatility. So this combines the two worlds which I love.
So what is this, VIX for bonds?
It is VIX for bonds in a way. It's based on implied volatility, which we now know what it means, on a basket of 1 month, 2-year, 5-year and 10-year and 30-year treasuries. So it's again looking over a 1 month period ahead, but for various parts of a yield curve. Of course, for stocks, you don't worry about time, but for bonds, you do have to. And it's also measured in basis points rather than percentages as the VIX index is, but it's the number of basis point moves you'd expect in the yield curve. And to first order, the yield curve does move up and down in a parallel way. Again, I'm showing my arm moving up and down, which you can't see. So that volatility is what people are pricing in for how yields are going to move in the future.
What's interesting about bonds, or at least what bond traders say is interesting about bonds, is that they tend to be more predictive of economic conditions and just generally a more sensible asset, right? Which is going to give you some temperature gauge. So is the MOVE index, therefore, maybe a bit more predictive of periods of trouble than the VIX?
Certainly it's true that when there's trouble in the treasury market, which underpins every market on the planet, that signals trouble for everything else, including things like equity, credit, everything. So if there's a tremor in that market, then you really have to pay attention. And I think the problem here is that nobody ever talks about bonds unless there's a catastrophe, whereas people talk about equity all the time.
Sometimes you force me to talk about bonds, Roman. I'm never happy about it.
It's for your own good, Michael. But look, this is a great thing to monitor because the news flow won't tell you if there's a problem, but MOVE will. So it's always a good idea to keep your eye on it. If you haven't got access to it, the poor man's move is to take some kind of treasury index like TLT and work out the realized volatility over recent periods like 1 month. Or just watch the price of that ETF. If it moves down, you can see there's a problem.
But then you're looking at realized volatility and not implied volatility. And the interesting thing about MOVE seems to be that in at least some occasions where we've experienced turbulence in markets, the MOVE index has risen and shown that something big is coming a couple of days before VIX has panicked.
Yeah, because those knuckle draggers in the equity market take a while to realize there's a problem. Plus, they're always optimistic, so they always think, oh, it'll be fine. Whereas the fixed income market, they always think there's a disaster. So they're going to be more sensitive to it.
So should we be trading the sort of spread between MOVE and VIX? Is that going to give us a positive return?
It's not consistent. So sometimes the epicenter is the equity market, often. And when it's the MOVE index, which signals the problem first of all, it's usually a bigger problem. But I don't think you could trade it, certainly not as a retail investor. But keeping your eye on it as a barometer of things to come, I think that's definitely interesting.
Thank you for joining us for Many Happy Returns. Do send us your questions, no matter how dumb, at the email address mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.